Hello and welcome to InvestFlow. With this video I will be starting a new series on my channel where I will be talking about some basic concepts in investing, talking about fundamentals, talking about how to pick a stock, what is a stock, what are alternatives, things like that. So I know that the market can be very intimidating if you don't know anything about stocks. So my aim is to kind of take the fear away and explain the basics in a understandable way. So let's get started. So the first question is, what even are stocks? If you look around you in the world, there are tons and tons of companies, and these companies employ real people, they produce real products and offer real services to hopefully better our own lives. A stock represents an ownership in this company. So for example, if you look at Microsoft, it would be the stock Microsoft Incorporated with the ticker symbol MSFT. You can purchase these stocks on stock exchanges with brokers, and every piece of stock you buy, every share, represents a piece of this large company. And with this ownership of the company, you are entitled to a part of the profit, or at least the expectation of profits in the future, this company is generating every single year. From this you can profit in two different ways. One of them is stock price appreciation. So for example, let's say you buy Microsoft at $300 and in 2 years it might be at like $400. So that's some appreciation in the stock price. And the other way to profit are dividends. Dividends are basically money that the company pays out to their shareholders. So for example, if you own one share of Microsoft, you would be getting, I think, around like 60 cents each quarter, so every 3 months. So these are the main two ways you can profit with stocks. The next question would be, why pick stocks? Basically, there are two alternatives if you want to invest in companies. You can either pick your own stocks, or you can buy an index or ETFs or generally funds. So for picking stocks, there are a few reasons to consider. One of them is you will be learning a lot about businesses. If you do pick stocks, you should do at least some analysis on the business model. By doing this, you expect to get alpha over the market, so you get the expectation to generate a higher return than the general market. And you can personalize your portfolio. With this, you can, for example, adjust it for your own moral compass. You can adjust it by your own personal knowledge or your own personal comfort. So for example, let's say you don't like gambling like myself. So you can pick these stocks that don't get profits by gambling, for example. Or tobacco, for example, is another popular one. Then you can also see, for example, you work as a software developer. So you might know something about software developing and tools and in general the process. So you might want to pick companies that you understand from your normal work. And then you can also adjust everything to your own risk level so that you can sleep well at night. This would be the personal comfort. There are a few things I would always consider if you plan on buying stocks. This will be first your risk level. Stocks are volatile. That means they can go up, but they can also go down. But in general, over a long period of time, good businesses tend to go up. So different stocks might be more volatile than other stocks. For example, if you take a small biotech company that's developing the newest cancer medicine, that one's gonna be extremely volatile. So take that into consideration. While a more seasoned company, like for example, let's say Nestle, is not as volatile and will, due to its size, continuously produce predictable results, at least to some extent predictable. Then another question is portfolio size. How many stocks do you want to buy? Do you want to buy just a few stocks, maybe 5 stocks? Do you want to buy a big portfolio with 40 stocks or something like that? Then there are also alternatives like ETFs, which I will get into in another video, crypto and gold, real estate, a lot of different things. So you can mix all of these components into your portfolio. Another very important thing is you should always keep some emergency fund. Because the worst thing that can happen is if the market is crashing, but you need cash to pay bills or something like that. So always take an emergency fund and pay down your debt before you consider investing. So let's take a look at some categories of stocks that might be a good fit for your first investments. The first category would be companies you use the products of. So maybe you use an iPhone or a MacBook, so you might want to look into Apple. Or companies you know from work. So maybe you're working at a construction site, then you probably know the products of Caterpillar. Then it's also good to start with companies that are easy to understand. So once again, don't pick some fancy looking biotech that's trying to develop a new cancer medicine. You won't understand it most likely. Pick something you understand, for example Home Depot, easy to understand business model. And then also something good for a first stock is look between B2C companies. B2C means business to customer. So for example Walmart, basically companies that sell to customers and not companies that sell to other companies. These are normally, or at least in some cases, harder to understand. So let's take a look at some basic metrics you should learn for a start. If you start analyzing businesses and stocks, you will be pretty overwhelmed by a load of different metrics you can look at, ratios and all that kind of stuff. So I took 5 of them that I find are pretty easy to understand and are pretty good to estimate business values. The first mistake a lot of people do when they first get into stocks is confusing market capitalization with share prices. So if you look at for example Amazon stock is around $3,000 per share. You might think to yourself, that's pretty expensive. We have Apple here for around 150. That's so much cheaper. But that doesn't really picture reality correctly. You should always look at market capitalization, which is the price per single share multiplied by the amount of shares outstanding. So Apple has a lot more shares outstanding that you can buy or that people own than Amazon. So the share price doesn't really say anything because the market capitalization is what matters. Another very important metric is the PE ratio. This pretty much is the price to earnings ratio. So it estimates how many years of profit a company is valued at today. So for example, let's take a company that's let's say worth $10 million and they earn $1 million. So the price earning is 10 because the market capitalization of 10 million divided by the earnings of 1 million equals 10. So here you want to invest in companies with a relatively low multiple compared to their competition. But don't just look at multiples. There are many other things to consider. Another interesting metric to look at is the growth in revenue and earnings. This pretty much just means you should look how fast the company is growing and if it's growing at all. If you see a company that's not growing but shrinking, that's always an alarm sign in my opinion. Another very important metric is the dividend yield. Like I mentioned before, some companies pay a dividend. The dividend yield pretty much means how much money you're getting per year. Let's say a company's share price is $100 and the dividend is $2. So that means it's a 2% dividend yield. Then another important metric to look at is the debt the company has. Basically, just take a look at the number and compare it to the market capitalization and the earnings. The numbers shouldn't be too high. There are also a lot of different metrics about it, but just in general, keep it in mind for the start. There are lots of different websites that give a quick and easy understanding of these metrics for the different companies. The one that I like to use the most is Stratosphere Investing. For example, this is the page of Home Depot from Stratosphere Investing showing the key ratios. So you pretty much see all the ratios I talked about here. You see the long-term debt to total capital, So basically how much debt they have in relation to the capital. You see the revenue growth rates in percent. You see the price to earnings ratio, and you see the annual dividend yield. I will link the website down below in the description. Before we continue, I would kindly ask you to like the video and subscribe to the channel. But also encourage you to ask any questions in the comments down below. And yeah, stay tuned for new videos in this video series about basics of investing. So let's take a quick look at risks. There are 4 different stages roughly in a company's lifespan. The first is the introduction stage, the second the growth stage, the third the maturity stage, and the last one the decline stage. In the introduction and growth stages, companies are more risky in general. Mature companies typically have the lowest risk. This would be something like a Home Depot, something that's already well established and makes a lot of profit in the best case. And you should definitely avoid declining companies. These are really not great investments because the performance usually drops. It's hard to find out about this, but just to keep it in mind generally. So take a look at stable business models, easy to understand businesses with low to medium valuations for a start. Another important aspect about risk is diversification. Ideally, you want to own a basket of stocks to be diversified, and you want to know the companies so you don't have to worry about them, how they will perform. So let's, for example, take a look at this portfolio with every company attributing 12.5%. In this portfolio would be Apple, Microsoft, Amazon, Home Depot, Nike, Tesla, Coca-Cola, and ExxonMobil. So even if, nothing will happen to these companies probably, but if any of these would go bankrupt, for example, you would only lose 12.5% of your money and not everything. So always spread the risk, at least in the start. It's also very important to keep calm. Markets go up and down, they make a lot of noise. The media will throw news articles at you every day. Every day there will be scary news about companies, about the economy and stuff like that. But you should just zoom out and think in years and decades, think for the long term. You should only invest money you don't need in the next year or few years in the best case. And that's why you also always should keep a cash reserve, so you're not forced to sell in tough markets. If we take a look at Microsoft, for example, we can see that in the last year there were a few cases where you would have lost a good bit of your money. And if you, for example, bought here and had to sell here because you need to pay bills, and that's a terrible thing to do. So stay safe and keep calm and just zoom out. If we take a look at Microsoft over the last 2 decades, it paints a very different picture. When you invest, you will see that everybody makes mistakes. Nobody is perfect and nobody will only make profits. You will also lose something in some companies you buy. But the important thing is to learn from them. And from experience I can say that you learn a lot more from a loss than from a profit. If you profit on something, you might think like, I know how this works, I'm great. But if you lose, you will start to question what you did, where were the mistakes, and that's how you have to think. You need to analyze what went wrong, and you need to come up with how you can avoid this in the future. So to summarize, you should buy businesses you know and understand. You should do basic analysis on these businesses. You should keep calm and know your risk profile. And you should always have cash on the side for emergencies. So this concludes the first video in this series. I hope you enjoyed this and learned something, and hopefully you will subscribe and stay tuned for the next videos in the series.